Hello, I'm David Ferguson, and this is the M&A Advisor Live from the Eversheds Auditorium in the City of London. In alliance with Merrill Corporation and the support of Eversheds, Dealgate, and British American Business, the M&A Advisor is pleased to present Growth Drivers and Deterrents, the 2016 Outlook for European M&A. As most of you know, the M&A Advisor has been hosting over 2,500 leading dealmakers each year, together with policymakers, media, and academics, for the discussion of those subjects that are most relevant to our practice of M&A. Increasingly, we're being asked to assemble small salon-style gatherings for more intimate conversations about those subjects, perhaps considered sometimes more sensitive. We're very pleased to be able to broadcast and invite you into this room today for a salon-style gathering and a discussion about our outlook for European M&A. During today's broadcast, you can ask questions of the panelists. I think if you look at the bottom of your screen below where I am now, you'll be able to see the place to ask that question. Type your questions in, and we'll do our very best to answer you through the course of our assembly today. Today's program is being presented by the Merrill Corporation. The M&A Advisor and the Merrill Corporation share a common goal for the advancement of our industry. 4 years ago, we created a series called The Best Practices of the Best Dealmakers. That program has become the most valuable voice of our industry, allowing the inside story to be told by those who make the deals possible. And we're very honored to be able to bring you today's program, the latest installment in our thought leadership collaboration together with Merrill. Now I'd like you to join me in watching a short presentation about the Merrill Corporation.
This is progress. This is seeing the forest through the trees and seeing the trees through the forest. Replacing the most complex content and regulated communications with advancement, taking action and taking away confusion, bringing chaos to its knees. This is success secured. This is Merrill Corporation. Leading industry expertise fused with agile connective technology. This is our DNA, what sets us apart and propels you forward. This is unparalleled expertise, the people you want on your business, brains that solve problems before they arise, people you count on. 50 years of industry experience, literally thousands of transactions yearly, millions of contracts securely uploaded. This is forward-thinking technology. Seamless connectivity that unlocks productivity. Access with unsurpassed security. Technology that connects the dots, closes the gaps, and gives productivity its groove back. This is unmatched service, not the cliche 24/7. This is around the clock, around the globe, wrapping our heads around your unique needs. Zooming in and zooming out to see the bigger picture, the lay of the land, the overarching goals. We have your back. We have your future. This is ironclad security. Cross firewalls, cross companies, cross borders, cross time zones. Merrill ensures complete security, accuracy, and seamless connection. This is a win-win. This is Merrill Corporation. Secure success.
The M&A Advisor opened our offices here in London just 18 months ago, and we've been enjoying the opportunity of bringing our service of assembling the leaders, analyzing and reporting on the trends in the M&A and restructuring markets, not only here in the UK, but across Europe. But long before landing on the ground here in London, my co-host for today was a valuable, trusted resource to us, and his musings on what's happening, why it's happening, and what could possibly be happening next is something that we've come to rely on. Ben, you've been on the M&A beat for over a decade now. You've worked for every major business publication in this market. Even though you've left the masthead per se, you can still continue to be consulted and write for those. And I think most impressively for me, since founding Betavel in 2014, you've had well over 18 million hits, which tells me that you certainly struck a chord through your journalistic career.
Thank you very much.
It's great to have you here. And I think, Ben, your perspective on what's happening in the market today and the origin of that perspective, I think would be valuable. And perhaps we'll kick off today's roundtable session with your introduction.
Right, yes, so Ben Harrington. I've covered M&A for the last decade. Started off as a junior reporter covering M&A at a publication called Merger Market in the mid 2000s. Spent a year and a half there cutting my teeth on M&A reporting, and then moved to the Telegraph, the Daily Telegraph. Worked there for 8 years as a staff correspondent covering M&A, private equity, hedge funds and stock markets. And then a couple of years ago left the Daily Telegraph, and now I'm work freelance, primarily for the Sunday Times, the Mail on Sunday, a little bit the Times, Dow Jones, and I also have a blog called Beaterville that's quite widely read in the city. So yeah, so I've been covering M&A and been involved in breaking some quite big M&A stories, including the merger of Carphone Warehouse and Dixon's Retail, but I've also covered the mid-market pretty thoroughly as well. So got a good handle on that. So yeah.
Great, thank you, Ben. Anthony Dahlwood is the CEO of Gresham House, and certainly a veteran here in this marketplace. I'm going to ask you as well to make a self-introduction.
Thanks for that introduction, David. Veteran, interesting. Tony Dahlwood, currently Chief Executive of Gresham House PLC, a specialist asset manager in illiquid strategies and long-term asset management strategies. Previously, I was at Phillips & Drew Fund Management as a director there for many years, and then I followed that on with becoming Chief Executive of SVG Advisors, which was formerly Schroeder Ventures in London. I'm currently non-executive director also of JP Morgan Private Equity in Guernsey, and also chair of the London Pension Fund Authority, which is one of the viewed as local government pension schemes in the UK. My philosophy was one of the questions we had. I am steeped in a value-style investment philosophy, long-term horizons, and one that focuses on cash flows and what the prices you pay for an asset.
Great, thanks, Tony. David Evans, Managing Director for Alvarez & Marsal. Greatly appreciate your introduction, and as with Tony, I think sharing a little bit of your perspective on your philosophy and how it's evolved over time for M&A here at home.
Okay. Hello. As you say, David Evans, Managing Director and European Practice Leader for Alvarez & Marsal. Although they're known primarily for their restructuring services, we're also very much in the transaction and due diligence side. We have a global team of over 200 ex-Big Four professionals serving primarily the private equity community, but also increasingly the corporate market as the Big Four find themselves increasingly enmeshed with audit-related conflicts, etc. I started off my career at Arthur Andersen before joining Deloitte as a partner, where I spent 13 years latterly heading up their transaction services team in London, and joined Alvarez & Marsal in January. I'm a UK chartered accountant and have over 20 years of experience working with both big ticket private equity and mid-market private equity and multinational clients. In terms of my philosophy, being the numbers guy, the bean counter on the panel, I think from a sell side perspective, it's preparation if you want to have a successful transaction, and from a buy side perspective, doing as much work as you're allowed to do so that you actually go in and properly understand the cash flows and the underlying business. But in the current market, that's actually quite tough, as I'm sure we'll come to shortly.
Thank you, David. And at my far right on the table is Richard Pulford. Richard is the Managing Director and focused predominantly on the north of the country, but I know with transactions that will take you just about anywhere at the DC Advisory.
Thank you, David. Yes, just a little bit more on that. Richard Pulford, Managing Director, DC Advisory. Our firm is a leading European mid-market financial advisor in corporate finance. We define mid-market as transactions 50 million euros-ish to 500 million euros-ish. We'll do things either side of that. About 60% of the things we do are cross-border. And one of the reasons behind that is our ultimate ownership is a Japanese investment bank called Daiwa, who are one of the powerhouses in Japanese equities. My own personal background, so I think we're probably now in either the third or the fourth M&A boom that I've been through after having been more than 20 years in corporate finance. And our philosophy advising clients, a lot of it will revolve around actually timing and dynamics underpinning demand for businesses. So what's the right timing given the demand drivers on the sell side? And it certainly feels now is the right time to be the seller of a business. But we also advise buyers of businesses. So how can you square an M&A boom with still wanting to invest in businesses? And I think that's all about adequately pricing in risk and adequately assessing upside. So timing's got a lot to do with everything we do. My career's taken in a lot of London. I had the last boom in London, and I went to Manchester in 2008, exactly 2 weeks after Lehman's fell over. So I've seen both ends of the country.
Tremendous. Thanks, Richard. James Morris is the relatively newly installed investment director at LDC.
Yeah.
And we'd love to hear about the journey to that position, as well as maybe a little bit about your philosophy.
Okay, yeah. You're right, I'm pretty new. I'm investment director out of the London office for LDC, which is mid-market private equity house. Been there 8 months. I'm in a new business team focused on origination. Part of my journey prior to joining LDC, I spent 10 years at 3i, which is a pan-European private equity firm. I started off in business development up in Manchester. I know Richard from those days. Moved down to London and ended up being head of research for 3i before coming over to LDC. And I think the thing that I'm struck with LDC since joining is the appetite to do deals. It's just incredibly hungry to get out there and make deals work. And I think when I look back over the history of LDC from a different point of view, only being in new, is that they've been quite consistent through the cycle about investing, and and it continues. We've got a pledge to invest £1.2 billion over the next 3 years, supported by our parent, which is Lloyds Bank. And I think looking forward into that next 3 years with my crystal ball, we're going to be talking today probably about the global economy, uncertainties, the pricing of assets, debt, and some of the political uncertainty. So it's just incredibly challenging. But I think, the thing that underpins private equity from an LDC point of view is just backing quality management teams. And that's my philosophy, is to get out and meet them and build a strong relationship with management.
Thank you, James. Mr. Robin Johnson, Global Practice Leader for Eversheds. Yeah. Someone that we've enjoyed having on our stage in the United States on several occasions.
Yeah. Well, thank you very much for coming to Eversheds, David.
It's a pleasure to be here.
Glad to have everyone here. As David said, I'm the leader of the cross-border M&A team at Eversheds, which is about 250 people worldwide. We've, as all the advisors have mentioned, we've seen a significant upturn in activity in the last couple of years. It probably started in summer 2013 and has just gradually accelerated to now. In that time, we've seen deals done by strategics, both buying and selling. We've seen deals by financial sponsors, buying and selling. We've seen spins, we've seen public M&A, and we've seen private M&A. We've seen venture. So we've seen a variety of deals you can think of. I just recently had 100 of my people in Milan, and we had a meeting to discuss what we thought was happening in the market. And it's fair to say that the enthusiasm and the fact that everyone felt they were going to carry on being very busy was very much paramount in that meetings. But what's particularly striking was the fact that certain jurisdictions which have had a bad time were more confident now. Southern Europe, there was a sense of optimism. The Nordics were excited about the opportunities, notwithstanding the oil crisis. And then other countries which maybe have been more introverted, such as Germany and Italy, were seeing opportunities through large private held companies to actually look internationally at opportunities. So I think we've got a mixture here of consolidators and aggregators. We've got people who are prepared to be consolidated. We've got people who want to consolidate. And I think the other thing, as Richard mentioned, was that at this moment in time, we seem to have a situation where where sellers are able to find buyers and buyers are able to find sellers. And so we seem to be in a bit of a perfect M&A environment.
Well, I think, thank you, Robin, and I think probably the best way to kick off the dialogue amongst us is to segue from that perfect dialogue statement. I guess the big question that I've got is how did we get to where we are? So we've had a perfect storm. So 2015 saw over $5 trillion in announcements, 3.7 trillion in transactions closed. So here in the United Kingdom and across the European continent, what is it that's transpired? How did we get to this point? Why 2015, not 2017, not 2011? Tony, can you lead off that discussion?
Of course, David. The world and history shows that there are cycles, and we're in another cycle. The last bottom of the last cycle was 7 years ago. You look at economic history, the average cycle lasts 7 to 10 years. Hey presto, we're 7 years on, and then we're towards the top of another cycle. And we're at the top of a transaction, M&A volumes, values, and hey presto, we've got different things saying it's different this time. And I'm looking forward to seeing how different it is this time. I think the underlying slight difference here, but it won't necessarily mean to the outcome in terms of investment returns, but slight difference is the fact we're in a global interest rate environment which is almost zero. The amount of money and capital flowing around the system is unprecedented. And as a result of that, it's distorting asset pricing. And you are seeing that in all different manners at the moment. At the moment, people are trying to look for safety, momentum and growth, and they're pricing that very highly. Those things which perhaps have had bumps in the roads, profits warnings, haven't been able to hit their targets, have been derated and depriced quite substantially. And people don't want to own those. They want to go into the quality areas. People have perceived for the last 5 years quality as being the area they want. And if you look back in history, value and growth, if you believe in all of that, we've had a growth and momentum focus for the last 5 years, which has led to valuations in particularly those areas, whether it be TMT, particularly technology, software companies now, average pricing, we were talking earlier about things, we're talking at 15 times EBITDA multiples, pretty normal for a software deal. The expected returns from that is going to have to be, the growth is going to have to be pretty punchy to get a decent return from that. However, you can look to the other end of the spectrum, which may be companies that are industrial or cyclical, they're not really wanted known, they're on EBITDAs or PE multiples at 4, 5, 6, and the expectation on growth when you buy something on that level is much, much lower. The ability to make money, history suggests, is much simpler. So I think, to answer in summary your question, we're at the end of another cycle. How long that's going to last because of this unusual quantitative easing and interest rate cycle is another matter, but we're at the end of another cycle.
So I've heard it said that perhaps we're in the middle of the cycle, and that this cycle could be a little bit longer than the last one, based on where this one began and just how desperate a situation that we found ourselves in. James, what's your perspective on that?
Well, I don't really want to call the cycle. We're definitely in a cycle. The M&A market is cyclical. I think, as I said at my opening point for LDC, the key is being consistent through the cycle. Last year, we deployed 350 million equity across 14 assets. Similarly, we did very same numbers in 2014, maybe a bit more actually. So consistency is key. In terms of how we got here, I think for us at LDC, we've stuck to our knitting and we just maintain the same model. We've got a regional network of 8 offices. So it gives us great access to management teams and M&A out in the regions and across the UK. And through that, we can build some strong relationships with management teams to get to deals before anyone else. I think overlying that, you've got the economic conditions, which has sort of bred the situation we are at the moment. There's been, a recovery in consumer confidence. It's been a deflationary environment, and real incomes have risen as a result. So this is all, made confidence much more tangible and extended the cycle a little bit longer than maybe where it should be.
Richard?
Well, I remember calling the cycle in 2002 and 2007, at the time as a relatively young man in my career, thinking I don't quite understand what's driving values. And I used to hate the phrase, it's different this time, which was trotted out each time. I think there are some differences now, though, because if you look at the two things that drive these cycles, first is confidence, and second is availability and pricing of money. I think the 02 and the 07 booms, or the end of those cycles, were driven much more comprehensively by confidence. The tech boom was going to change the world, and it has changed the world, but people just disconnected pricing from the underlying assets. That was a confidence-driven boom. The 07 boom, also confidence-driven. I think what's slightly different this time is I think, Tony, you put it really nicely, the unprecedented flows of money, because we're in the middle of what's been described as the biggest financial experiment in history, which is QE. It's driving of seemingly permanently low interest rates. And that's led a lot of money looking for a home. And I think that in private equity terms, there's more than $1 trillion of unspent private equity money looking for a home, $1 trillion of dry powder. Most of that will be looking in mature economies like US and UK. And I think this pricing point is very important, because Tony referred to this. We're seeing a real bifurcation in the market, that risk aversion, oddly enough, I think has gone up amongst the investors. And so they are happy to pay much more money than they might otherwise have done in other cycles for either incredibly resilient businesses or ones with stellar growth opportunities. And then there are an awful lot of other businesses that really struggle to command strong investment appetite because they don't have those same characteristics. So I think I'm with Tony in that it just naturally feels like we're nearing the end of a cycle, but I still think there are legs in it because of this availability of money.
Great, thank you. And I do want to come back to the discussion about strategic buyers versus financial buyers, and I think it's an age-old question, but it feels like it's particularly relevant right now at whatever stage we are in the cycle. But David, let's have you weigh in on this subject first.
Sure. Well, I agree with everything that's been said so far, but I think there's a couple of additional factors driving things. One, if you look at some of the big headline deals, they're being driven by the Chinese coming in, not necessarily applying normal valuation techniques for companies that have either got good IP or technology that they can then take back to their home markets and exploit there. Or in particular, as we've seen, brands. I've worked with a number of private equity companies looking at brand-related acquisitions, and it seems like at the last minute, a Chinese strategic has come in and paid, just blown everyone out of the water in terms of valuation. I think a second factor that's driving that is in the private equity sphere, the mid-market as defined in the US, which we define as sort of those funds with 1 to 5 billion of equity. And there's a lot of them, a lot more than there are here in Europe, are increasingly looking to Europe, where valuations, at least relative to US valuations, have seemed cheap, driven perhaps by the European economies taking a bit longer to recover from the recession. The low euro has certainly helped, and about half the deals we worked on last year at Alvarez and Marsal were with US private equity funds with no presence in Europe coming in and investing in European assets. So I think that's definitely fueled things. And then finally, when we're talking about the big mega deals, we shouldn't ignore the impact of tax, particularly in pharmaceuticals. You know, although tax inversions are a bit of a dirty word, and I think are not the only reason for some of those deals. There are perfectly decent commercial reasons for the deals, but I think they've definitely been a factor that when boards sit around the boardroom table and they see opportunities to materially reduce their tax bills through, you know, acquiring overseas competitors and flipping the tax base. I think that's definitely driven some of the big headline deals that we've seen in 2015.
I know Ben wants to talk about sectors, and we certainly want to talk about technology and the mega deals, because I think over 50% of the mega deals happened here in Europe in 2015, and it's a big question about whether that's going to continue. But it certainly seems to be a very good climate for it. So I know you want to talk about sectors, but I wouldn't mind going around the table just to get some perspective on that strategic versus financial advisor. Whose year is it going to be, or is it more evenly weighted, or is it leaning towards one group or another? Robin?
What I'm told, and I apologise for this before I get told that's just not the case, is that a lot of and I think LDC is actually the exception, to be fair, is that
You can say anything now.
Is that the private equity players are all fighting over the same assets, and there's a scarcity of assets, and they're all looking for the likes of a Richard to actually find them deals, and there's a lot of secondaries and tertiaries going on because there's a lack of potential new assets out there. Now, whether that's actually true or not, I don't know, because I actually think this might be the year where privately held companies actually do start to look at their options and as to what they could possibly do in terms of being a consolidator or an aggregator, or look for an exit. So I do think in the private held world there are going to be some opportunities. Now, what strategics are telling me is that they've dusted off their black books and they have been trying to avoid processes, and so been telling people, you know, when you're ready, come to us, we'll do some sort of deal with you. They don't want to get involved in auctions. And it's interesting what Dave was saying about the Chinese, because, you know, the feel I have is the Chinese do not want to get involved in an auction. So they'll either come in with a knockout price to avoid an auction, or they'll stay out of a process. And I think actually there's quite a few strategics who don't want to waste their time looking at in an auction process. So there may be a different dynamic here in terms of potentially more bilateral deals. I think David is also right about the large mega deals, and that's why I think there's still some energy still in this particular cycle, because only in the last few weeks we've seen the Dow and DuPont, we've seen Johnson Controls and Tyco, and these just going to feed on more deals in the marketplace. So I think a traditional private equity house needs to find some way of finding new deals other than doing secondaries or tertiaries. Strategics, the boards are confident. The boards are giving executives permission to go and look at deals, but I also sense they don't want to get involved in auction processes. So it's hard to judge, really.
Yes, please.
So I think, we're going to follow a normal cycle. Yeah. What normally happens towards the end of the cycle is that the corporates go, I haven't done anything yet because I'm risk averse, and it's been I could ride the growth on the way up because the macro environment's helping me. And now I've got shareholders telling me I've got to carry on. I've got share prices telling me that I'm on 20 times earnings. How am I going to keep that going? Oh my goodness, earnings revisions are rolling over. The world is slowing. How am I going to keep that going? I need to do a deal. And that's where we are at the moment. And I think that the mega trend, the end of the cycle tends to be this stupendous M&A. We haven't quite had that, although the volumes and values do say that, but we haven't quite had that. And I think that's going to happen this year. I think the evidence of that is you look at earnings revisions across Europe and indeed the US. They started at 10 plus profit growth this year, and they're down in the low single digit. I mean, arguably, some people are up to speed and now putting them at zero. Summary, earnings revision come down. How are we going to grow this year? I better do a deal. And I think we are in that discussion at the trade buyers, strategics as you call them, as we speak. And the PE will then struggle to compete because, I mean, we're on 15 times and the trade buyers will come in and say, well, I'll put 20% on that, and then they're out the game.
Yeah, and I think that's true, particularly when you understand that corporates are sitting on huge cash balances, record cash balances than ever before. So, you know, whilst there's £1 trillion of firepower across private equity, you know, there's just as much sat on US and UK PLC corporate balance sheets. So what does that mean? It just means it's a good time to sell businesses to corporates. I think, you know, just to plug LDC again, we sold 10 businesses last year, delivered £500 million of proceeds, 7 of which went to corporates, where US buyer in one case and a Chinese buyer in another. So just sort of underlying the sort of international nature of M&A. But at the same time, for a PE house, whilst it's good to sell, you've got to also invest through the cycle as well, because there's nothing worse than not investing.
Yeah, sorry, just to come out, there's one dynamic that does fault in what I'm saying, which is the fact that debt is now freely available again, which means that the average trade buyer, particularly listed, the shareholders get very, very nervous if you're at 4, 3, 5 times EBITDA. In fact, it's just not going to be allowed by their shareholders. But it's normal, it's normal to have 5 to 6 times EBITDA, debt EBITDA multiples within a PE transaction, and
covenant light.
Yeah, exactly. And I'm sure you've seen it now. It's hit.
Although we're actually, I think, coming off the top of that cycle. That in the US, in the last sort of 2 or 3 months, those debt markets have really been squeezed,
Yeah.
and we normally see it takes 6 months or so for that to filter through across to Europe. Because I think the debt markets is one where I've been most concerned about what's been happening, that we have had 2007 leverage packages back again over the last 18 months, for some of which the businesses will be fine, but there's not a lot of headroom if there's a hiccup along the road for those businesses, and it just feels that there's a little bit too much leverage out there at the moment, and I think it will be compressing. As soon as that happens, private equity pricing comes down. Going back to your point, trade who are late to the game come in, which is why I think there's probably another year, 18 months of this cycle to go.
Tony, I'm reminded of a conversation that you and I had in the fall, and you shared a really interesting piece of research that you had done on the cycle of sectors, and those that are in, soon to be out of favor, and how they act and react, and not always responsibly during that time. And I wonder if maybe you could share just a snapshot of that, and then I'll hand it over to Ben to talk a little bit about the sector outlook for Europe for the year ahead.
Sure. I think you're referring to the piece that Gresham House wrote regarding the value companies and the growth companies sectors, and at different points in economic and stock market cycles, companies are different. They may be in the value category and the growth. So if you go back to the late 90s, 99, the growth were, of course, the TMT. That isn't, and that changed. Back then, Imperial Tobacco and British American Tobacco was far from growth. It was very much a value stock and dividend yield of 10%. Now it's the stable quality business that people will put on a dividend yield of approximately 4, PE of just under 20 times, which then was back at 7 times price earnings ratio. The point is things come in and out of fashion and put people different expectation multiples on it as a result. Coming back to the point where we are in that sort of dynamic, the last 5 years, value versus growth. Growth has been extremely strong. Companies that are perceived to have momentum and high growth, relatively growth characteristics, have done very well, and those that value lower price to book has done poorly, and that's as bad as it was back in the 99 peak of the TMT boom, i.e. the value was terrible at that stage. And then the subsequent 5 years was fantastic for those value companies, and you lost half your money in the growth area, but you actually almost doubled your money in the value area. And some of the stats out there now suggest we are very close to that sort of point in time again. And I think it comes back to where you pick and choose. Some PE wants to put 15 times EBITDA multiples, and then some are actually still looking down at the 6 and 7 times. And I would argue, it's simpler to make returns in those where the valuations are lower. Economic history suggests that you can do that.
I'm sure that opens up a whole Pandora's box for you, Ben, when it comes to sector conversations. Let's talk a little bit about what's going to happen and where.
Well, so last year we saw, some of the mega deals that you brought up. Anheuser-Busch InBev going for SAB Miller, Royal Dutch Shell going for BG Group, and a whole load of pharmaceutical transactions. So I guess I'm not going to speculate on what deals are about to happen. I'm just going to throw it out there and ask Tony, I guess, where you see M&A, which sectors you think are going to be particularly prevalent for M&A in 2016.
Normally those where growth is struggling and people are trying to manage their ratings in terms of the shareholder expectations. So what you have is management typically at the helm of these organisations where they, if they can internally focus and where they're in control, manage the situation and grow their profits, that's the lowest risk way of doing so. So they'll focus on that. We're getting to a stage now, as I said earlier, where it's harder to do internal, the return on equity cycle, which if you believe, you believe in that, which is, frankly, if you go back 100 years for all things, it just goes in a nice cycle. It suggests that we're towards a peak of return on equity, which means it's harder to generate supernormal returns from this point. If that's the case, that is when the M&A advisors come over the hill and say, we've got a trick for you, because we can do something which you can't internally generate, and why don't you have a look at. And then, they get focused with some great advice from these great people to say you should do that deal. And of course, they're thinking, well, if I'm on a P of 20 or 15, how do I manage? Here's some growth, some revenue synergies, which are thrown in for good measure, as well as the cost synergies. And then they get motivated by or excited by what could be. So where are we in that today? Clearly, the likes of mega pharma. I mean, that is, those are areas where it's hard to grow because of what's coming out and all different dynamics in generic competition, particularly, and also the likes of the exchange rate and currencies. So that's quite well touted. We've seen in what was once the very boring, if you go back to the 90s, the boring industries of Grand Met and Guinness, which is now Diageo and all this. They are the go-go, so they weren't back in the 90s, they are now. And you can see that is almost playing out. There's not too much left in terms of ability for M&A. I think if you look at the where things are struggling, whether that oil exploration and production, clearly the return on capital cycle needs to improve. Capital needs to be taken out of that industry. What normally happens, again, going back to the 90s when we had the oil at $10 at that stage, is we saw an enormous amount of M&A transactions. Enterprise and Lasbo springs to my mind at that stage. And then the capital came out in the following 3 years, shareholder returns are substantial. So in summary, there's 2 or 3 sector areas which I would see some activity.
What about Robin? Where do you see, which sectors do you think are going to be particularly busy this year?
Yeah, so I mean, what I'm hearing from our clients is that they don't particularly want industrial capacity. That's not what they're after. So it's more the technology side of it, but that's what everyone says. They want to find the technology that's going to enhance the business. Having said that, I'm also hearing about people who think they can be co-manufacturers and supply goods to companies that may want to become technology companies, diverse technology companies, rather than diverse industrial companies. We think there's quite a lot to go on in healthcare. We think there's actually quite a lot to go on in energy as well. So not necessarily straight oil and gas, but actually looking at maybe some of the renewable investments that were made and actually realising value in those. And that's not just talking about the UK, we're talking about cross-border here. Someone mentioned consumer earlier. Consumers driving a lot of opportunities. So there are some quite high multiples in consumer. How long that will last for, I don't know. I just did a deal where it was 20.3 times. But that was 3 particular people after the same asset. And it was done in a 2007 style deal where it was done in a week at 20.3 times. And that was in the consumer sector. It's hard to tell what's going on in financial services and whether there's going to be a lot of activity there. We keep talking about it, hasn't happened.
Richard, have you got any views?
Yeah, I mean, I see this as driven not by particular sectors, with sectors having a set of characteristics. It's more around what's an investor looking for. And I see clients looking for really three things. First is growth. The second, which is linked, is can you grow internationally? And third, can you do so in a way that's scalable? And then that lends itself ultimately to particular end sectors in the mid-market. So IT is one of them, particularly anything that you can build as software as a service with a recurring revenue stream that doesn't cost you much to bolt on new sources of revenue, and therefore it flows to the bottom line, command very strong prices. But I think it's rather than a sector thing, it's those aspects of growth, internationalisation and scalability that people are looking for. Certain sectors lend themselves to that better.
David?
Well, I actually have I have a question from our audience, from Sotiris Bantas, who's curious about Chinese enterprises. And David, maybe I can throw this over to you, since it's an area that I know that you focus on. He's particularly interested in what the impact on technology will be. And I would just offer, as in our study of technology, and particularly if we all embrace the notion of the fourth industrial revolution, which was the theme of the World Economic Forum this year, that interestingly enough, those companies related to Internet of Things saw very significant investment levels in 2015. And in fact, over 50% of those investments in the third and fourth quarter were made by companies with no technology underpinning whatsoever. So these were non-technology companies, traditional companies, making investments in technology, to your point, Robin, for the advancement of their business. Now, some of them expect to have things that will be part of that 50 billion item universe that will be communicating with one another. But others are organizations that just want to make sure that they're secure in what's a blinding pace of change that's occurring. So how do you think the Chinese could factor into that equation, particularly here in the UK and Europe?
Well, as I've said already, I think we've seen a lot of M&A with Chinese companies wishing to effectively acquire established Western technology and then take that and re-engineer it effectively for their home markets. We haven't seen as much of the protectionism as there has been in North America, where a number of deals have been blocked because of concerns about sort of supranational concerns around Chinese enterprises, where where does the state stop and the corporate start. I completely agree, though, with the broader thesis, and I was going to say, from a sector perspective, I think TMT is an area where there will continue to be deals, be those driven by the Chinese or by others, because at least in the space where I've been operating, we've talked about convergence for about the past 10, 15 years, but we're really, truly beginning to see that now, both with the Internet of Things, with smartphones, etc., driving all sorts of must-have applications that none of us now could probably do without, but we didn't know we even needed them until 2 or 3 years ago. And for those of you that have got young kids, you'll see how they're growing up with technology in completely alien ways to, I think, the way that we've all had to come to interact with it. So I think technology will definitely be a driver of M&A. Richard, I completely agree with you. Anything with a subscription type revenue model is increasingly being bunged into the TMT category. Things that probably wouldn't have been badged as TMT until recently by smart advisors like you, of course. But I think Chinese, Indian companies will also look to acquire established technology, but I still think you can't overlook the US. A lot of the technology deals I've been involved with have ultimately been driven by US corporates or private equity. They look at what Europe does. Europe's actually quite innovative in a number of these areas, and there are some really good businesses that are being grown. So,
I mean, just on the Chinese point, David, if I may. I think it's interesting that last week, the Fairchild Semiconductor deal was stopped by the US regulators. Let's see what happens to the Terex deal, where again there's been a Chinese a player trying to stop the merger between Terex and a Finnish company. And then we saw 3 weeks ago the deal with Syngenta in Switzerland and the Chinese. So when you see those, and that actually is going ahead, or it would appear to be going ahead at the moment. And so when you think of the difference between Europe and the US, if you can think the Swiss are happy for a deal between Syngenta and a large Chinese agrochemical company, but the US are stopping deals still in the US, that's bound to mean that the Chinese will look at Europe as the opportunity. The fact that they seem to be able to fund our nuclear program in the UK without that being, would that ever happen in the US? And I think that is why I think the Chinese will look a lot at Europe in the next year or 2 years.
There's quite an interesting parallel with the London property market. If you think what's driving that is not UK-based employees and their salaries, it's international flows of money into places that are perceived as a safe haven, or certainly safer than the places from which those flows are coming. And those same geopolitical drivers work in M&A as well. And there's a reason why it's the London property boom and not the equivalent in Chicago or Philadelphia or whatever, because the UK in particular is much more welcoming to international flows of capital.
This was very much part of the conversation at Columbia before we started today. I was sharing that Columbia University hosts an annual BRIC Lab, Emerging Markets Lab conference, and 3 years ago, our legal community of M&A attorneys was figuring out how to align with CFIUS, with our regulatory body. 2 years ago, for the most part, they had it, and a year ago, we would have said, we figured this out now. This is actually going to be good for America. Well, the bears have come out of hibernation, and most certainly it may be the pace of technological change, it may be the application of technology across so many different levels of business, but I think we've become frightened again. So it wouldn't surprise me to see more investment from the Chinese here, where this is a much more fertile ground for investment, and certainly the application of their technologies is as large combined as it is in the United States.
Just sort of bringing it back to sectors for a moment. I think I agree exactly with Richard's point, and Tony, when you talk about value companies, for me the businesses that look interesting are those value companies that are applying some level of technology, whether that's on the customer acquisition side or the supply chain or controlling of costs, just transforms them from value back into the growth section, and that's where the PE finds that interesting, and you can almost bunch them under TMT, and it's how do you categorise TMT? That's the thing. It's a bit of a catch-all, isn't it? The way General Industrial used to be a catch-all for packaging and aerospace. So it's funny how we describe things in our world, and looking at PE, they do travel in packs. There's been a whole bunch of travel and leisure deals recently. Including ourselves, we did invest in a business called Igloo. A few other travel agency businesses out there that have been done this year, and one that we haven't talked about, which is sort of on the lips of lots of people, particularly the VC, is cybersecurity. I know over in the US there's been a whole ton of money spent on that, particularly by corporates, and that's going to have a knock-on effect across Europe.
Can I just jump in?
Yes, please.
Because I think if we talk about sectors, but it isn't quite a theme I'm thinking of, but it is relevant. Public to privates in UK and Europe have hardly happened. They go for a cycle, and they go for a cycle for various reasons, particularly risk appetite from private equity side, risk appetite, access to capital by the management teams of public companies. We are at a cyclical low in that, actually, in the last year or so, if you compare to certainly 10 years and probably going back 20. And access to capital is getting harder in the public markets, particularly for smaller companies. And smaller companies now, you can go up to £1 billion, but let's talk about 250 million and below. Access to capital, despite being quoted, is very, very, very hard. And people, quite rightly, the management teams will turn around and say, what's the point? Why do I bother? That is happening. That is happening. We're back at that stage again. I'm looking at advisors because it's not the normal hunting ground of PE because you have to go through different risks, execution, etc.
And the rules changed a couple of years ago, which make it actually a little bit harder for private equity to do public to privates. But I think one of the underlying things is there doesn't seem to be a great deal of value. I mean, I look at a lot of PTPs, and what's markedly different now than 10 years ago is that there aren't those companies that are trading on tiny multiples where there is a proper value arbitrage to be had, because everything's been uprated, and it's pretty difficult to find that real value.
I would urge you to run that screen again.
In the last sort of 8 weeks or something.
It's trebled.
Yeah.
And I think that's the interesting bit. And because what happens then, it takes a while for advisors, stroke management teams to go, actually, I can't access capital, my rating says this, what's the next step? How do I go? And that's a period, and that period typically, in my head, is sort of 6 to 12 months as they get their heads around it, and then they go, where do I go? So I think the end of this year, middle of this year, we'll start seeing more of those discussions, and you guys will be in the middle of that.
You're absolutely right, and actually, since the new year, we've actually had 3 ones where we've had to produce documentation to allow management to do things. I mean, the other way to do it for private equity is actually to get a platform company and then do the public to private. So private, where they actually get a platform first and then do a public deal. And actually,
a quoted platform.
Yeah, no, get it unquoted, but having got the platform ready, actually use the portfolio company to actually do the acquisition. I don't know whether you're seeing that at all, but that's certainly what I'm hearing, that using portfolio companies to do buy and builds is now also very attractive for PEs rather than just doing one-off investments.
Is that something that's on your plan?
Buy and build is always front of mind for private equity, and I think about 30% of our portfolio have had some form of bolt-on acquisition. And obviously, it just depends on the circumstance and the business.
What you can find and what value can be agreed upon. I have a question from our audience while we're still on the subject of low-cost money, and we can segue from there. But this is Mike Powell from Woodside Capital is asking, yes, we understand the value of low-cost money, but how does historically low-cost energy affect the M&A market? Since it's the underpinning, certainly in your region, and across most all businesses that we're engaged in some form.
Well, there's real
perspective on that
in this, because if you look at the break-even cost of oil for countries across the world, I think we're below that for most of the developed Western economies, and that's generally a bad thing. And I think that the economic effects of that outweigh the benefits for manufacturers of having lower energy input costs. So I think with oil at wherever we are today, somewhere between $30 and $40 a barrel, that's the overall economic effects in the West are net negative, I think. Sure, there are some positives for large consumers of electricity or power, but the overall economic effects are net negative. You just have to look at what's happening in the oil and gas M&A market, which has gone from boom to restructuring in the space of 6 months, and that's generally a negative effect for companies whose cost of getting oil out of the ground is anywhere above $20, and that's most of us.
Well, we've certainly seen the sector take the headlines in our distressed and restructuring dialogue that's happening on the U.S. market side.
Look what it's done to the shale gas extraction market in the States, and look what it's done to that market in the UK, which has basically chopped it off at the knees before it's got going. So that innovation, low oil, makes it not worth innovating in the same way, and I think therefore is just bad news.
This is one situation where being first to market in the case of the United States didn't exactly pay off, at least not in the short to medium term. Ben, I think we were watching the countdown clock. We're at 6 minutes, and the most popular question, not surprisingly, that I'm getting here today was a subject that I think we determined about an hour and a half ago needed to be part of the dialogue, and that, of course, is is that story that's dominating British media, and that is, should the UK stay in the EU or should it exit? We know where the Prime Minister firmly stands. His report over the weekend was followed up by an address of Parliament today, and we also know, as of yesterday afternoon, exactly where the Mayor stands. And I think we'd be remiss in not having a conversation about where this assembly of M&A market leaders stand. And I don't want to put you on the spot. And I know that you have to consider both your personal and your professional opinion. But Robin, if I can start with you.
Yeah, so this is the personal opinion. It's not the Eversheds' opinion. I don't actually know what the Eversheds' official line is, to be perfectly honest. But without getting into the rights and wrongs of whether or not there should be a referendum or Brexit, let's be absolutely clear that if, in fact, the UK people do vote to leave Europe, you can't just be in Europe one day and out of Europe the next day. The consequences of actually leaving Europe should not be underestimated in terms of the legal environment. Because for the last 30 years or so, 40 years, we have got a web of connections into Europe. And so if, in fact, we voted to leave Europe, we would have uncertainty for at least 3 years as we try to create a new state of the United Kingdom. And people should not think this is a decision that's going to be made in June and forget about it in July. If there is a vote out of Europe, this will have disruptive effect on the legal system in the UK for at least 3 years, I think even longer. And I think that's bound to have an effect, obviously, on M&A. So leaving aside the merits and demerits of the situation, the consequences of a vote out from a legal perspective is going to be very difficult.
Well, I'm looking forward to seeing just how that message is disseminated before the vote in late June. James,
yeah, I think that's a valid point, Robin. I'm going to pass on this question as I'm still working it out. And
well, it's very fresh.
Well, I think there's probably 2 ways of looking at this. First is, can there be life outside the EU for the UK? Of course there can. Of course they can, and can it be good for our economy? Of course it can. There are plenty of other countries in the world who are not part of the EU who are doing perfectly fine. So of course they can. But to Robin's point, the sheer complexity of extricating ourselves from the EU is one thing. What that brings is massive uncertainty, and it will bring a lack of confidence in making decisions on the part of corporates or anyone looking to invest, because until you have absolute clarity what the regulatory, legal and commercial environment is going to be like, people will not make investment decisions. So it's going to introduce sclerosis into our economy for, I would say, actually at least 5 years until the ramifications of it work their way through. So as a person at my stage in life, I don't want to see that 5 years of uncertainty and chaos.
Great perspective, thank you. David?
I completely agree. It's going to have a negative short-term impact on an M&A, because people, particularly overseas buyers, want some certainty around what's going to happen. And I think the UK has benefited, particularly with US purchasers, from the perception that we're the friendly landing point before they step off into that market of 500 million people. From a personal perspective, I'm a bit worried that we've let the genie out of the bottle. I'm not sure the referendum will sort things, almost regardless of the result. People will be unhappy because it's going to become very polarising. And as we saw in Scotland, something that was supposed to be a once-in-a-generation settle it for 10 years seems to have just emboldened people who lost the side of the argument to push yet again. So from a personal perspective, something that was ultimately driven by politics rather than anything else, and some internal issues Mr. Cameron had with his own party, I am quite worried about the effect it could have for the next 5 years.
Thanks, David.
I can only reiterate this. I mean, this country is is adaptable and flexible. It is a capitalist country at heart, and it's done very well. A socialist capitalist, I suppose, at some degree, but it is a capitalist and it adapts. So it will be fine. If anything happens, it will be fine. But that period of interregnum and the capital flows, the risk, the pricing of risk around capital flows into the UK will be substantial. As a result, inertia will be enormous during that period, and everybody involved in that will suffer temporarily. I am convinced it will be fine post that, but how long that time is something that, again, I don't necessarily want to live through whilst we just try to do business day to day.
And Ben, you get the last word.
20 seconds.
The last 20 seconds.
I agree with everybody here, actually. My personal opinion is I'd like for us to stay in the EU. Yeah, I think I hope we do.
Well, thank you all. This is a particularly interesting time in M&A. I feel so fortunate to be a part of it and to be able to report on it, not only to our constituents here across Europe, but also to the United States. And I thank you very, very much for joining me. I have one shameless plug. On the 25th of February, we'll be hosting the launch party in New York for the 3rd edition of our Best Practices, the Best Dealmakers series. Together with Merrill, we've hosted over 200 contributors to this series. I think it's continuing to prove to be as important as these assemblies with wise men like yourselves. Thank you so much.